Hey, good morning, everyone. Marty Mazzora here. It is Monday, the 2nd of January, 2023. Happy New Year to you all. U.S. markets closed today. European equity markets, most of them are actually open this morning. And so far, Europe seems to be in rally mode to begin the year. We'll see, of course, how the U.S. market opens up tomorrow morning. Today, as is the norm, we're going to take a look at the technicals for the market. I'm going to zoom out and begin with the monthly chart, which was probably the major technical tool that had us pinpointing 3,500 as the bear market bottom. However, that was before we saw recession odds exceeding continued expansion odds. And back then I issued the caveat that 3,500 looks great to us if we're not experiencing recessionary conditions when we get there. Unfortunately, that's what we believe we're experiencing currently, so we think that it is likely, or that odds favor the market dipping below that 3,500 mark, we think sometime in the first half of this year. But before we get to the technicals, I just kind of want to paraphrase some of what I wrote on last year's four-part end-of-year letter, which concluded this last week. And for those of you who don't get the blog, if you'd like to, just shoot me an email at marty@pwa.net, or just go there at blog.pwa.net, and you'll see literally hundreds upon hundreds of blog posts that I've authored over the last many years. But this year, toward the end, that last part four, I essentially said that, as most clients certainly know, that we remain on balance bearish for the time being. Stocks, as I just suggested, we think we're going to see lower lows, or we think odds point in that direction. And other than what the technicals may be presenting, and more importantly in our view, kind of the basic, very basic fundamental view, is really just three simple bullet points. And none of these should be mysteries to anybody. In our view, and in the view of most economists, odds favor a recession this year. In our view, it'll be a mild recession in our current view. Corporate earnings estimates, in our view, clearly don't reflect a recession in 2023. So if we have one, of course, that should mean lower earnings as people pull in, and therefore lower stock prices. Excuse me. The Fed and the European Central Bank in particular continue to voice their commitment to tighter monetary policy in order to tame inflation despite rising recession risk. And you couldn't think of probably a worse setup where central banks, major central banks, are tightening policy into a recession. Now, there are bulls out there. One of the premium services that we subscribe to, BCA Research, which is the oldest research firm in the world, their equity strategists actually are pretty bullish on the economy going forward. And this would be their basic, or this would be any bull's basic contention, and that is that this consumer remains relatively strong. Just look at the service sector PMIs, for example. And consumer sentiment is actually kind of in the gutter, but it's been improving a bit lately. But their actions seem to speak louder than their words, at least from the bull's perspective. The labor market is still uber strong, no doubt about it. Inflation is absolutely abating, no doubt about it. China is re-engaging with the global economy, and they're going to do so aggressively, no doubt about it, although there's some real spike in COVID cases, so we'll see how that plays out. So these factors, when you put them all together, suggest that that maybe it's premature, or maybe it's a little too pessimistic to be forecasting recession for 2023. But of course, we can counterpoint those things that I just mentioned. And one would be that while the consumer continues to spend on services, their credit card balances are going up quite rapidly, and savings rates are absolutely plummeting, suggesting that people are borrowing and pulling from savings right now to at least at the margin fund that spending. So you have to wonder how sustainable that strength of the consumer is. this strong labor market has been targeted by the Fed. And the suggestion there is that we're going to need to see it weaken further, or we're going to need to create some weakness to get inflation under control. So the Fed does not seem to have the labor markets back right here. Indeed, again, inflation will continue to abate in the short run. However, using China, for example, that's probably a net inflationary phenomenon if they continue to bust out. I looked at New Year's Eve photos in China. It looked like they're having a great time in the streets. And the Chinese government are absolutely committed to stimulating their economy in 2023. And of course, we have a 1.7 trillion in U.S. government spending to hit the economy as well. So these look like inflationary factors. Our view is that we do dip into recession, likely the first half of this year. Inflation continues to abate with it. Things get dicey. Fed really backs off. Second half of the year, infrastructure spending in the U.S. and in other places kick in. Places like Latin America, which we're very bullish on, which have pushed their policy rates through the roof, come off of those policy rates. You get growth over there, and you get potentially some pretty good growth momentum going into the election year. However, you're also going to have inflation come roaring back with it. And I say roaring with some hesitation. Absolutely. We think structurally inflation is going to be higher. And while we'll get these short-term cyclical moves with recessions and economic slowdowns, these move lower, the structural factors will keep inflation buoyed. And you'll see probably some notable increases coming off of these short-term cyclical slowdowns in inflation. So challenges for the market, no ifs, ands, or buts about it. We also believe that this roaring dollar has probably seen as good as it's going to get, and a weaker dollar over the next few years, if we're right, really plays into our bias towards foreign equities and commodities, for example. However, over the near term, those things that have worked, that did work last year, could actually suffer more so than things like U.S. growth stocks and like tech stocks, in that first half of this year. So clients in our core portfolio, we have these longer term biases that we think make just incredible sense, but we do think there's some short term downside risk that could lead to some underperformance. So what we did just at the end of last week is we did just a little bit of hedging for the first quarter using options of our industrials, materials, and U.S. miners exposure. And again, we could come roaring out of the gates, just like Europe looks like it's starting to this morning. And I'll make a short-term technical case for that here in a minute. But we think as we meander further into the year and even into the first quarter, we could see those cyclical areas really deliver some underperformance, which is okay on a short-term basis. We just want to make sure that if something does break, we're not terribly exposed to that. So we're doing our general hedging still because we still think we're in bear market conditions, hedging on some of these industrial materials and miners positions that we have as well. So we do think that we need to be nimble. We do think we need to continue to play some defense. We do see some real light at the end of the tunnel as we get into, we think, the latter half of next year and into 2024. That's the world as we see it today, always subject to change because we do not wed ourselves to any thesis. We just keep doing the work. Okay, so to the technicals, in front of you is that monthly S&P 500 chart. And remember, we went way back and we identified these sell signals on the moving average convergence divergence, which are not that common. This is a 30-year chart for the S&P 500, and when they occur on the monthly chart, not good things tend to occur. And as you can see, right, you have your sell signal here, sell signal here. I dotted lines some that were sell signals, but just, you could do the same thing in here, but really weren't conclusive and probably not even worth circling. But when you could circle them, you had pretty severe double-digit drawdowns, and when you could circle one into a recession, it became pretty darn ugly. Back when we said 3,500, we weren't looking at recession. And so the sell signal outside of recession, along with the 50-month moving average and retracements and so forth, had us targeting 3,500, which is exactly right where we hit. Just came just below that in October, and then sprung right off of that. And again, we said back in here that we'll probably get more aggressive there, but we didn't because, per my caveat, we had read on our general conditions index, which said recessionary conditions. So we bounced back up to the top of the trend line here and rejected it quite violently in December. And so we're looking more like 3,200-ish now at the bottom of this range. And if we're in recession and we can work through some things and central bankers get scared, then we could springboard off of that. Those other pro-growth, pro-economy factors that I've mentioned kick in, and then then we're off to our next bull market. So we'll see. That makes the most sense to us currently. Since I'm taking so long here, I'm going to go ahead and skip to the daily chart. And on the daily, it's interesting because you don't really have a good positive look here, but I'm going to give you one here in a second on the hourly. So I had, if you can tell this dotted line in here, when I touch on it, it bolds for you. That was beginning to look like a bear flag to me. We have kind of broken down below that, but we've been dancing right on that 3,800 support, which we've talked about here on previous videos as being probably pretty strong. And sure enough, that's been holding for multiple days here. But when we throw in our momentum indicators, it's not looking so good to me. So you see you have finding support here at 3,800, but you have your MACD here for the same time period continuing to slope lower. That would be a negative divergence. The RSI, however, is holding up. So far, so good there. We could definitely break out of the top of this, what is really a descending triangle right here on a short-term basis. We could break out below. Time will tell. When I look at the hourly chart, we had, this falling wedge, broke out of it. We had a bullish divergence right there, found resistance right here, and created this real definite trend line here on the hourly, right? But we had continuing bullish divergences here, right? You see your lower low here and your higher low here on these two. And then we broke out above that and have been wrestling again, of course, with this 3,800. But this looks bullish to me, folks. This looks like we could start January at least with a rally as we are in Europe so far. So again, don't know that that's going to happen. Doesn't look so good on the daily. And then you go to the weekly and the monthly, and you're still very much in bear market technical conditions to us. But on a short-term basis, right here, there is hope for the bulls who are looking for a nice pop in January. And again, if I look across the European complex right now, they're sure getting it over there. Let's see if that holds, and let's see if it bleeds into the future session here later this evening here in the US. And then, folks, let me just close again, getting away from the technicals a little bit, and share with you the latest scoring of our, what we call our equity market conditions index. This is something we created back in August of 2021. We track 12 different areas that we think are very telling with regard to equity market conditions. Score them every month. We just do this one monthly, not weekly, like our general conditions index. This is actually the S&P 500 for December. As you can see, it was down 5.9%. So, not a good December. Good fourth quarter. It was a real good October, November. So the market was still up, but December itself was down. Our equity market conditions index dropped 16 points to negative 33.33, so not good. And just here's my one paragraph narrative. A short-term bullish technical setup for the dollar, okay, which is bearish for U.S. equities in our view. Tougher rhetoric versus November from the Fed. Overall breadth, on balance deteriorating from November. S&P 500 technicals net bearish, save for the short-term charts, which I just showed you the hourly. And generally poor macro conditions, that's our PWA index, copper-gold ratio, other things we look at, more than offset an improving contrarian sentiment, meaning people are showing us net fear, and slightly more attractive valuation setup. For the first time in a long time, we're actually saying that valuation on U.S. equities are actually neutral to us. So stocks are more attractive now than they've been in quite some time in the U.S., and that's bullish. Stocks are very attractive. in other parts of the world. Much more attractive in Europe, as I shared, I think, in part 3, maybe it was part 4 of the year-end letter. So folks, go there if you didn't get to see those. And, Latin America and other places as well. So inputs that showed improvement were valuation, sentiment, inputs that deteriorated breadth, as I mentioned, Fed policy, technicals, inputs that remain bearish, sector leadership. The dollar remains bearish because short term it's looking up. We think longer term it's going to look down. Economic conditions are bearish. Credit market conditions aren't horrible, but they're net bearish. We're neutral, fiscal policy, geopolitics, and interest rates, and so forth. So since inception, you can see just right after we began this index in 2021, it began to show us red. And then here's the S&P from the point that we began this index. And this index is just, again, it's just another, and I won't go through all the details, but it's just another overall kind of macro indicator that gives us a feel for equities. And again, we're in commodities, we're in fixed income, and so forth. Read part 4 of the year-end letter if you want some of our input there in those areas. But for today, on a short-term technical basis, or from a short-term technical perspective, I think we could see the beginning of January look okay for U.S. equities. Beyond that, we're open to that bullish argument that I shared with you here a few minutes ago. But on net, on balance, we think the risk-reward setup more supports something a bit uglier, probably within the first half of next year, and some huge opportunities from a macro perspective beyond that we are going to be here to hopefully fully exploit. Folks, I'll leave it there. Thank you, as always, for watching and listening. Happy New Year to you all. And we'll be back at it in 2023. Blog subscribers, look for the morning note tomorrow. And wish you all well. Take care. Bye-bye.